Hi folks, and today we're spending time with George Milahopoulos from Connected Finance again. And these questions are a little bit curly, but I know these are questions everybody wants to ask, from what deposit you need when actually purchasing your home, right down to discussing mortgage insurance. Now, mortgage insurance could be for first home buyers, and it could be for people who are stepping into 3 or 4 properties where the equity in all the properties isn't stacking up, where they need, where they want to keep building their property portfolio, and mortgage insurance might come into play. So, George, what's the typical deposit requirements when purchasing a property?
So typical lenders look for a 20% deposit. So they look to lend up to 80% of what a property is worth, and therefore require the client to make a 20% deposit and also cover the costs. Costs being stamp duty, legals, pest and building, and other miscellaneous costs. So generally, that 80% plus cost can be a substantial deposit required by clients, as a general rule.
Yeah, it's tough for young ones getting into the home market these days, isn't it? Now, I am aware you can borrow more than 80% though, so, and then you incur what's called mortgage insurance premium. Can you tell us what that mortgage insurance actually is?
Okay, so mortgage insurance is when, so obviously in today's day and age when properties continue to rise, saving up that 20% plus costs is really hard. One, it's really hard, or we simply don't have the time to do it. People and clients want to get into the property market as fast as possible, so therefore to borrow as much as possible, the banks introduced some time ago a mortgage insurance premium. This allows a client to borrow over the 80% mark. So for first-home buyers, some lenders lend up to 98% of what the property value is. So you can actually borrow a high percentage of the property value, and it means obviously for a reduced deposit by the actual client itself. And there is a cost for doing this, but at least it gives that client the opportunity to get into the property market.
Absolutely. So what are some of the guidelines applicants need to meet when taking out lenders' mortgage insurance?
The main criteria that is assessed with mortgage insurance, like a normal application, it looks at the strength of the application, but mainly it's around employment stability. So the client would have to be in the existing role for at least 1 year, if not in their previous role in the same industry for at least 2 years. The other aspect being their contribution. There is a minimum 5% contribution required. Even if they're lending up to 97 or 98%, the clients still need to show they have a 5% contribution that has been saved, and it's referred to as genuine savings. And what I mean by genuine savings is the client has to either have that 5% in their account for a 3-month period or more, or have to have saved that 5% over a 3-month period. So it can't be funds that have been gifted to a client. It has to be genuine saved funds.
And they've got to have proof of that as well.
Exactly right.
Now, can you borrow more than 80% for both home and investment properties and pay mortgage insurance?
Certainly can. So mortgage insurance is not only applicable to home loans, it's also applicable to investment properties. There are different lending ratios applicable to if you're purchasing a home that you're going to reside in versus purchasing an investment property. As I mentioned before, with a home that you're going to reside in, you can borrow up to roughly 95%, 97%, 98% with some lenders. With investment loans, purchasing investment property, the maximum that you'll find is up to 95% with certain lenders, but it ranges between 90 and 95%.
Thank you. Now, if you don't have a 20% deposit and you don't want to pay mortgage insurance, is there another option that clients can consider?
Yeah, look, it's really important that I disclose this option to my clients. As I mentioned earlier, mortgage insurance is a premium that you're actually paying to the bank for having that privilege of going over that 80% mark. Therefore, the transaction becomes riskier for the bank, and they charge a premium. And depending on the loan amount and the percentage of how much you're borrowing, it can be quite an expensive premium. So the other option outside of mortgage insurance is potentially using a guarantor. So a guarantor can be your parents or a sibling, where they offer their property as additional security, and that additional security is used to support your application. So ultimately, it just means that you can borrow a higher percentage without the need of mortgage insurance, because you're actually using family members' property as additional security.
And we come across this with a deal you and I were trying to put together not long ago, where the young couple thought just the guarantor was enough to get them over the line. You still have to meet certain guidelines and certain requirements. You've still got to be employed full time. You've still got to actually show your 5% minimum or up to 20% savings. So don't think mum and dad's property is just the only way to get you into the property market. You've still got to follow some of the guidelines, but it is a great way of actually getting into the market.
Yes, certainly is.
Now, for clients to understand their best option, again, I encourage you to call George. He's got a wealth of experience. He's coming from a banking background. He's got a business banking background. And I know that he's going to be able to help you with all of your property needs. And he's helped many of our clients. And sometimes, you know, we've been really, really late trying to pull a deal together, and he's been able to get them across the line. So I really appreciate your time and your help with our clients, George.
Excellent. Thank you. Appreciate it too.